You're about to hear my conversation with Marcus Otima, Executive Director at CIBC Capital Markets. Today, we're peeling back the layers on ETF trading. The discussion will explore the real drivers behind ETF trading costs, from spreads to market conditions, and how these impact trade execution. We'll talk about how different creation redemption mechanisms influence pricing and the indicators advisors should use to assess costs and liquidity in ETFs. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. I'm your host, Prerna Matthews, Vice President of ETF Product Strategy. There's more to ETF investing than meets the eye. And the MER is just the headline. In this episode, we flip to the fine print and unpack what investors often overlook: spreads, premiums and discounts, and the structural mechanisms that impact total cost and tradability. We're joined by Marcus Otima, Executive Director at CIBC Capital Markets, to explore how capital markets desks keep ETFs running smoothly and what advisors need to know to avoid cost surprises when building client portfolios. Marcus, thank you for joining the podcast today.
Thank you, Prerna. It's a pleasure to be here.
Wonderful. Let's dive right in. Getting to the fine print, most investors primarily focus on MER, but there are some less obvious costs, particularly for investors that are first timers or relatively new to ETFs. Can you tell us what those are?
Sure. Yeah. I mean, there's a lot of potential cost implications when investing ETFs. MER, as you rightly pointed out, is the most obvious one, but the least obvious ones are, bid offer spreads, which I'm sure we're going to talk about a lot. In particular, bid offer spreads are also. It's not just the spread; it's also the price of the ETF itself. So, like a 1 cent bid offer spread on a $10 ETF is basically the same thing as a 10 cent per share spread on a $100 ETF. So it's not quite that simple. You can have something that it trades in 5 cents at $100, and that's actually a much cheaper ETF to buy from a cost perspective. Um, there are potential tax implications. Depending on the type of ETF, if it's active or index based. There may be unnecessary turnover within an active ETF, for instance, whereas a passive ETF may have less turnover and therefore tax implication from a capital gains perspective. Distributions as well can impact how much tax you end up having to pay. And then there are fees. The ETF manufacturers like myself, we have to pay creation redemption fees when we create units of ETFs. So all of those, there are other potential costs as well, like depending on what how you actually input your order, whatever system you're using, you may have a transaction cost or a flat fee on shares or something like that to consider as well.
Thank you for highlighting both the implicit and the explicit costs that investors can and do face. Let's stay for a minute on that bid-ask spread discussion. So you've highlighted certainly that active versus passive ETFs, there can be a difference in how spreads might look. Not everything is necessarily a penny wide, and that means very different things based on where the NAV of a product is. And of course, there's NAVs anywhere from $10 in this market to over $200 in this market. So a penny spread can mean very different things. What about geographic exposures? That does that have an impact on the spread that an investor could expect as well?
That can absolutely have an impact. So first of all, depending on what time you're trading. So if you're trading an ETF, let's say that has an international component to it, in the morning, let's say Europe is open while Toronto's exchange is open, but at 11:30, the European exchanges may close. And if you're trading something with European exposure, the market maker needs to account for the fact that they can't actually trade or hedge the international component at that time. So that translates typically into wider bid offer spreads on those types of products while the underlying market's closed. And that's kind of a theme, throughout like other products as well. It's like, there's we're coming up on a U.S. holiday in Canada, and so Canadian markets will be open, but it'll be you'd expect to pay a wider bid offer spread if you're trading an ETF that has a US underlier on a US holiday.
Okay, great points. Another few terms that often get mentioned in the ETF space are premiums and discounts on ETFs. So maybe for our listeners, if you can start first by describing what that means. What is a premium or discount? When can that occur in a product? And why should advisors, investors be mindful of that?
That's a great question. So, an ETF, if you think about it as just like a basket of goods, the price of the ETF should basically equate to, if you summed up the price of all the goods within the basket, and then you divided it by the number of shares that that basket represents, that will give you a price that's called the NAV. Now, each underlying security within the basket, if it's an equity ETF, will have its own bid ask. So there's that component as well. But for simplicity, let's just talk about the NAV itself. So, when you're pricing an ETF, you have a NAV, this NAV that is driven by underlying securities. But then, market maker needs to be compensated for the fees that they pay. So there's going to be a spread put on from that NAV to drive a bid and an ask price that you see on exchange. But there's other forces that can be at play. So if there is significant demand for an ETF that maybe outstrips the amount of shares that a market maker is prepared to offer or bid at the time, there can be secondary market forces that actually drive the price away from its NAV. So if there's a buyer, like somebody that's aggressively trying to buy shares of an ETF on the market, they may be exhausting the liquidity that's they posted on exchange and then driving the price of the ETF to be trading at a premium to its NAV. Conversely, the same thing. If someone's selling aggressively, for instance, they can drive a price away, and the ETF will trade at a discount. Now, premiums and discounts do occur, and so you may enter into an ETF thinking that you've paid a really tight bid offer spread, but you actually just bought an ETF at a premium. Often when you'll see that maybe when there's let's say ETFs can and sometimes do close, and the moment an ETF closes, then it ceases to be like an open-ended product. It becomes a closed-end product, in which case then it really is driven by these supply demand forces and not by a NAV calculation. So that's something to watch out for. The good news is that when on open-ended ETFs, which is the vast majority of them that we trade, there is a mechanism to drive prices back towards their NAV. So I'll give an example of that. So if an ETF is trading at a premium because let's say the exchange liquidity has been exhausted, a market maker like myself may step in and see that and drive and be prepared to sell an ETF down towards its NAV because we have this mechanism called creation redemption. So if I can happily sell an ETF and at a premium and buy the underlying securities essentially at a discount of where I'm selling them, I can then turn around to an ETF manager like McKenzie, for instance, and create units of that specific ETF. So there's a driving force that will always kind of help drive ETFs towards their net.
Yeah, it's a great point, and again underscores the importance. We're going to talk a little bit more about this in the next few minutes around the importance of the market maker and the role of sort of keeping prices in line as well over the long term of an ETF. Certainly, those external factors that can also play a role in premiums and discounts to happen. Particularly in volatile markets, as we've seen over the past few months. Perfect. Okay, so that being said, let's now go even deeper. So we've had a great discussion around the key terms, costs, impacts, implicit, explicit, as it relates to trading ETFs. Now let's focus more on the role of the market maker, the role of CIBC, for example, in supporting ETFs, the buying and selling of them by investors, advisors. Can you walk us through the role your desk plays in the day to day? Like, perhaps we take the day in the life of an ETF, right? What happens at the start of the day? What does that look like through the course of the day for your desk?
So there are 47 different ETF providers in Canada, over 1,600 ETFs that are actively trading, and we make markets on all of them. Now we are DB, which means a designated broker, which means we have a responsibility and a contractual obligation to quote on about 260 of them, and that means that we are there at 9:30 to 4 p.m. quoting on exchange by obligation. But we are also able to quote on exchange on securities that we choose to quote, where we think it's economically rational to do so. So we are active electronically on exchange, two-sided market posting in about 600 securities every day. So like I said, there's about 1,600 ETFs. We are electronically quoting 600 of them. That leaves about 1,000 of them that we are not quoting electronically. But that doesn't mean that we do not quote them. They are just not every ETF is created equal, and some trade actively, and some are more kind of like over the counter, or we are prepared to price them, but we don't necessarily post our bank's capital two sided on exchange to do that. Now, what does our a typical day look like? Well, I mentioned 47 different providers, 1,600 ETFs. So what I like to use an example of I call it the bakery. We're kind of like a bakery where in the morning we come in, we have 1,600 different types of loaves of bread to bake that are provided by 47 different recipe providers. And we have over 50,000 ingredients with which to bake them. So what are we doing? We're basically taking in a ton of data from and it's calculating NAVs. We're calculating NAVs for 1,600 different securities, and preparing our platform to be able to calculate them in real time throughout the day. And so our morning starts off with downloading a bunch of data, processing the data, and then getting ready to post on exchange the ones that we're either obligated or choose to post. Um, so all that happens in a like our process like a bakery. We start very early. We have systems that come in thankfully at 4:30 in the morning and start chunking away at some of this stuff. And then by the time we get in, it's more validating and kind of tasting the bread and seeing how making sure that the navs look appropriate. And then as we approach 9:30, we then are posting size, putting the bank's capital at risk on exchange. So when you go on your investor's account and or whichever transaction means you use and go to buy an ETF, there's a good chance you were interacting with us directly, if it's electronically on exchange, or with one of our competitors, or if you're doing putting a block trade through, then we stand ready, willing, and able to facilitate that as well.
I love that, uh, analogy of the bakery. I actually haven't heard that one, and, it's a great one and one that hopefully will stick with our listeners. So, that is really it's great to understand what happens behind the scenes, with market makers. So, what if we have an advisor with a very large trade, either a buy or a sell into an ETF? Can you walk us through what does that interaction look like between the desk and the advisor, and how does that trade get executed?
Yeah. So um, I talked about the liquidity that we post on exchange, but that is not necessarily the liquidity that we are willing to trade. That's just the liquidity that we are electronically posting. If you have a large block to do, we are always ready to take that call, either by contacting us directly, if you're an IA, you can. There's typically a retail block desk that you can contact as well. We sit right next to our retail block desk folks who interact with the IAs, or to reach out to the ETF manufacturer directly, because we are in contact with all of them as well. So if there's questions about how to achieve best execution, et cetera, like that is an area where we can really contribute in the conversation. And so, there are some pitfalls to avoid. Like for instance, if you have a block trade, you probably don't want to do it right at 9:30 at the open, which it tends to be when the market is its most volatile and bid offer spreads are the widest. You may be unhappy with the type of execution you get, and that's really just reflection of where things are. And then similarly, if there's foreseeable events, like let's say an FOMC statement or a bond auction, like we saw yesterday in the U.S. There are those tend to be not the optimal times to execute. but again, like we stand ready, willing, and able to step in. The liquidity that you see is just liquidity we're ready to post electronically. Now, keep in mind, we're posting on 600 different securities, on like upwards, of $2 million worth aside. So we are putting significant amount of capital at risk at all times, but that does not reflect in the specific liquidity on any ETF you can get at any moment. What drives the liquidity of the ETF is really the underlying. So let's say you want to buy 100 million of a bond ETF, an aggregate bond ETF. Well, you know, you'd be crazy to try to lift the ETF because you exhaust the available stack. But 100 million in the bond market is not a big trade. So if you have that trade to do, then we can probably get you a price that's very reflective of near top of book levels,
Mhm.
if not top of book. Just because the underlier it has the liquidity, and we will not move the bond market on $100 million trade.
Yeah, that's a great those are great tips for advisors to think about and remember. I've read this stat before, and keep me honest, Marcus, but it's something like only 7%, about 7% of ETFs in Canada actually see trading on a daily basis, which I think a lot of advisors, investors don't realize. Does that sound right? Is that number about in the ballpark?
I mean, that number sounds low to me. I mean, but like actual trading, meaning like trading through a PNU, like a prescribed notional
Yeah,
unit,
yeah, yeah,
that may be about right. Yeah,
yeah,
but
yeah.
like in terms of, I mean, most ETFs will, or I'd say about half of ETFs will trade maybe a share or two, and that's often just to kind of get something on the board.
Right.
Like I think of like the 600 ETFs that we do price and trade throughout the day are the ones that we think will trade. That's
Mm,
about a third what's available. So the other 2/3 is kind of like zombie ETFs in a way. Like they exist,
yeah.
and just the fact that they don't trade doesn't mean that there isn't liquidity. I mean, like there are zombie ETFs that are, bond ETFs, and if you wanted to trade 100 million of those, you'd have the same liquidity as you would on one that trades on exchange. They just
Yeah.
don't benefit from a two-sided market, or like meaning you don't have necessarily secondary market flows that are keeping it active.
Secondary buyers selling and buying, on
Yes.
a daily basis other than the desks, the market making desks actually providing that liquidity. Fair point, and just an important reminder again for, Canadian advisors because the US market and Canadian market still look quite different, as it relates to ETFs. You've got a much deeper and more mature, ETF market in the US, where we're perhaps not having the same conversation, so it's just great to highlight that. We spoke briefly about market volatility already, but just given how critical, I guess, trading considerations are around that, I'd love to spend a little bit more time on that. How does market volatility factor into execution quality? You mentioned, execution quality as well earlier. There are times where advisors just are adamant on getting off a position and rebalancing into other parts of the market, and that comes at a cost. So can you talk to us more about that?
Yep. So obviously, market volatility on, if you're just going out and trying to buy a specific equity. I mean, during volatile periods, there's a good chance you may not get filled, or you may need to pay up more in bid offer spread just to get that exposure. On ETF, the market volatility, sometimes the structure of an ETF itself can almost act as a buffer around the volatility. That like you should expect bid offer spreads to be wider during a more volatile market. That's just normal, but um, again, the liquidity of an ETF is driven by the liquidity of the underlying, and there are different ways that an ETF market maker like ourselves can hedge. We don't necessarily, if we sell a TSF 60 ETF, we don't necessarily have to go and buy 60 underliers. We can hedge it through other means. There are we talked briefly about secondary market liquidity, so there is that. There are related derivatives that we can use. There are highly correlated instruments that we can dip into, if we choose. And so there's some scenarios where the volatility or like market liquidity has deteriorated, but the ETFs have almost acted as a price discovery mechanism. So during COVID period, for instance, bond ETFs started trading at significant discounts to their NAV, but then the bond market at the time was like the NAV was struck at a bond market that was effectively shut down for a period. So credit markets became very challenging to trade any sort of size of any kind. any kind of bond, sorry. And you had the bond market looking at ETFs to see where ETFs were actually striking. And so that was a very interesting development. And like ETFs were like kind of serving as that price discovery mechanism for where broad-based credit was, as opposed to where a single name should trade.
Yeah, that's great examples and also great reflection on the various points at which ETFs have been tested. I mean, I remember the same thing happening during the global financial crisis with high yield bonds and high yield bond ETFs at the time. And then even more recently, we've seen that tested in the early days of the Russia-Ukraine crisis as well. So it's always good to look back because when markets get volatile, you start to definitely see some of that uncertainty creep up with advisors who are just unsure about how to navigate it. So you've mentioned some great best practices or how to avoid trading mistakes with not trading early in the day, so the 9:30 a.m. trade. When you know that there are certain market events happening, FOMC statement, as you said. Are there any other reminders that advisors should be keeping in mind in navigating ETF trading?
You probably want to consider the underlying the underlying of what it is that you're trading. I mean, obviously, the most liquid underlier will have the most liquid dynamics for you. Trading, yeah, like we talked about trading at the open and close, trading around known holidays. You know, trading with too tight a limit can be a problem. I mean, limits are typically a good idea, and I definitely recommend using limits. But trying to sneak a an order and put it, you want to buy and you throw your limit on the bid side, your expectation can't be that you're going to get filled. So if you put a limit that's a few cents into the stack on the offer side, that's also your expectation as the buyer shouldn't be that that's the price you're going to pay. You're going to get all the liquidity. You probably will get filled at a much better level than where you think you will. But you have the greatest chance of getting your order completed. There's also, there are, NAV orders for large size is something we haven't discussed, but that's also an option. And a NAV order is basically where an ETF becomes the same thing as a mutual fund. You just take one NAV strike as opposed to an intraday strike. You just take a 4 p.m. Or depending on if it may be an 11 a.m. or something if it has an international component. Consider age of the ETF and size of the ETF. I think are also important factors, but they're like like an ETF can't be judged by its size or its age. But what I like to think of is like think of like size divided by age. So if an ETF has been out for 3 years, but the ETF has only grown to 100,000 shares, it probably means that it's not a particularly successful product, and you may end up it becomes one of those like thousand zombie ETFs that we talked about, and so you may end up paying a wider bid offer spread just to get the liquidity you want. So like maybe keep an eye for securities that do trade. They're the ones that dealers like myself are going to be most ready and like have the sharpest tools to be ready to price and hedge. The further away you go from a ETF that trades, the less likely it is that I'm going to spend time on any given day. When I'm baking all these different loaves of bread, trying to like I'll probably be focusing on my baguettes and my rye breads as opposed to like some very esoteric bread, let's say.
Yeah, good tips and reminders there. Of course, a number of ETF providers in Canada also offer ETF capital markets teams, desks, services to help provide any insight that we can in supporting advisors to trade, and of course, in collaborating with all of the trading desks here in Canada as well, and bringing that clarity along with, of course, the retail desks at all of the banks, certainly. Well, Marcus, thank you for sharing your insights today. It's been enlightening to hear from a capital markets expert who helps navigate these nuances daily for institutional clients, advisors, and through your wealth of experience, you've provided us with some really great examples and best practices here. So, thank you for sharing your perspective with us, Marcus.
Brandon, it's been an absolute pleasure.
That brings us to the end of this episode of The Invested. Thank you to our listeners for tuning in. We hope this episode has provided you with some valuable insights on how ETFs can be used in your portfolio construction. If you have any questions or topics you'd like us to cover in future episodes, please reach out via our blog or through LinkedIn. Until next time, stay invested. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.